Yo, what is going on YouTube? Today I wanted to make a quick video and kind of break down what actually moves stock prices and go over and review a couple basic fundamentals that may sound really obvious, but if you're like me, you're watching your investments, you're dollar cost averaging, you're actively reading the news and what's going on. This is meant to kind of help boil it down to some basics and keep it really simple and kind of help dispel some of the craziness that goes on in moves markets. So, riddle me this if this sounds familiar. You may have seen a stock have a massive pullback and drop 5, 10, 15, 20%, or you may have seen it go parabolic and shoot up 20%, like Micron has these past few months, and it's absolutely created crazy amounts of generational wealth. So, what the hell is actually going on in moving those prices? In its simplest form, a stock's price increases where there's more buyers, and it decreases when there's more sellers. And that is it. Yeah, it's that simple. Although, naturally speaking, there's some nuance behind why an individual or institution may be buying or selling on any given day. So let's jump into that. Now, as I just said, with supply and demand, it's really the foundation behind the stock market. And think about it this way: if you've ever taken maybe an economics course in your lifetime, or maybe you have no idea what supply and demand really is, it's just buyers and sellers meeting together to arrive at a price for a good or a service, or in the case here, our stock price, right? Equity in a company is really the better way to say it. But the key here is that the reactions to stuff going on in the market is really what can move those prices and have the sellers or the buyers show up in force. All right, jumping into another common stock price mover, and that is the earnings, or rather the performance of a given company. So think about it this way: earnings are typically done on a quarterly basis. So you'll hear, if you follow market news or you watch CNBC or whatever, there's a whole earnings calendar for a given year, and everyone gets really excited around earnings because it gives a forecast as to where the company is going for the remainder of the year, but it also is a scorecard for how the company has been doing on a given quarter, and that creates a lot of hype, expectations, and companies commonly, you may see this a lot in the news, will either exceed their earnings estimates or not exceed their earnings estimates, and buyers and sellers trade around earnings, right? So commonly, if a company does really, really well, they might get a little boost around earnings and their stock price might go up because more buyers will show up. Sometimes the inverse can happen too. It's a little bit more complicated. But if the company doesn't do really great with earnings or has really weak revenue forecasts, then you'll see more people sell the stock, right? Because there's more uncertainty about that company's future. So that's sort of a boiled down simplistic view of it, but that really is what a lot of these price moves are based off of. Jumping into another more macro and more broader kind of forces that can move the price of an individual stock is the Federal Reserve. Now, you may have heard in the news recently, the Fed has been debating increasing interest rates to combat inflation. That's almost a separate video altogether as to why they would do that and all those ins and outs, if you will, of that action. But the reality of it is that when the Fed changes interest rates, that can have impacts on stock prices. A simple example of that would be if the Fed increases interest rates and makes borrowing more expensive, that is likely to squeeze the profits and make a stock less attractive compared to if the Fed kept rates lower. Kind of a common trade-off that you see in the market. The other kind of nuance with it too is sometimes it can make stocks as a whole, so that's the entire equities market, less attractive relative to safer investments like bonds. So again, higher interest rates, meaning I'm getting a little bit more return on bonds than I would potentially on equities. So a broader kind of concept, and definitely one that is kind of sometimes forgot about if you're managing your own portfolio, especially if you're early in your 20s and you're really heavily focused on equities. But just understand that there is a trade-off between interest rates, and it can impact the attractiveness of stocks and bonds. Now, another key macro event that can influence stock prices is inflation. And we've probably seen this talked a lot about this year through the news, right? But when inflation runs really hot, investors tend to worry about rate hikes, which is kind of talking more about my first point. But if inflation has been persistent or sticky, as it has been these past few months or years, right? But investors can worry or have more uncertainty on whether or not that rate hike is going to occur. So that may trigger more selling. Now, another big one, and this has been top of every headline throughout this entire year in particular, but historically it's also been a really important thing, and that's just geopolitics and world events. We have seen on and off throughout this year the Strait of Hormuz conflict and oil prices being really high, war, and all this uncertainty makes investors very nervous. And as a reminder, investors are humans too. They have mandates and regulatory stuff where they have to protect their assets. So having wars and oil prices spiking in the Middle East creates tons and tons of uncertainty, therefore can trigger big sell-offs, right? And we've seen that several days this year, if you've been following the stock market kind of on a daily basis, where there's been large drawdowns or big sell-offs when a peace treaty gets broken or there's some disagreement that continues to keep going on in the Middle East. So, and this is a historical thing, right? This has happened many times throughout the course of human history. Now, I do have a bit of a bonus extra for you here. I recently talked about in my SpaceX video, and we'll link that in the description below, around indices and whether or not the S&P or the NASDAQ 100 may include a certain company. When a big institution like Invesco or BlackRock is forced to purchase a company, it has to buy a lot of that company. So we'll use SpaceX as our example because on July 7th, which is as of this recording tomorrow, those major financial institutions are going to be forced to buy SpaceX because the NASDAQ 100 is now including SpaceX. So they have to buy it, and that's so that way they don't have any tracking error in funds like QQQM or an ETF that tracks the NASDAQ 100. So that forced buying is going to create a move in the stock price. So to try to pull this all together, if you are watching your portfolio every day, or you're trying to manage your own finances and figure out what the hell is going on out there in the market, ultimately at the end of the day, it just comes down to understanding that there's sometimes more buyers and there's sometimes more sellers. It's just the other stuff that's going on in the economy that impacts everyone. I think it's worth paying attention to, but you don't have to, if you're a long-term investor, get worked up if you know that you're not going to be tapping into your brokerage account anytime soon. Sometimes it's just noise. And sometimes that noise is also worth listening to. So I hope this video was a little educational, maybe oversimplification of certain elements of the stock market. But for those of you who may be new to it, still trying to figure it all out, this at least gives you a bit of a background as to some of the basic factors that can influence stock prices. So would be interested to hear from you guys. Drop a comment below if you have any crazy questions around what specific companies had specific moves, and happy to dig into it and help out. Catch you next time.